But let's move on and shift focus to Ceat. That reported its numbers. When you're looking at a revenue of around 9% on a year-on-year basis is what they managed to see. Margins, that's seen a bit of a contraction. But what does it mean for the company going forward? Let's bring on board the CF of the company, Mr. Kumar Subbiah at Ceat, joining in with us right now. Very good morning, sir, and thank you so much for joining in with us on ET Now. I want to start by talking about the overall demand scenario now. How is that looking like currently? And how do you see the replacement market and demand for the OEM grow, maybe Q2 FY25 as well as in for the year FY25? How are we expecting that to move?
Good morning. Thank you for having me on your show. Broadly, as far as the market is concerned, we are seeing momentum in replacement and international business, and evident from kind of double-digit growth that we were able to deliver in Q1 in both these segments. And for us, original demand from original equipment manufacturers was subdued, which we hope, in the coming quarters, as we have been approved for some of the new models, we hope it to improve. In the market, we are seeing some robust or some kind of positivity in the demand, both from the replacement market as well as from the international market.
Right. And, I just want to know furthermore in terms of how much was the volume-led growth this time and how much was pricing-led growth in the quarter gone by. Also, what are your plans for more price hikes? Could we expect that in Q2? Are you expecting anything? And if yes, what would be the quantum of price hike you're looking at?
In Q1, all of the growth was volume growth. So approximately about 8.6, 8.7% kind of a growth of volume that translated to revenue growth. We did take some small price increases in the month of May and followed by another one in beginning of July. Looking at our current commodity prices, it's likely that we will go for some more increases in the coming days and weeks.
Right. I want to talk about exports as well, because you aim to improve export contribution to about 25%, right? How close are you to achieve this target?
Currently we're about 20%. Last year, we were able to grow exports faster than other business verticals. So therefore, the share went up from 19 to 20%. We have focusing on certain specific markets with respect to certain categories. So those plans are in place. One of the important deliverables for our export growth is launch of our truck and bus radial and passenger car tires in the US market. So as we speak, truck and bus radial tires are getting launched in the US, and a little later in the year, passenger car radial tires would be launched. And similarly, on the farm radial tires is also another growth engine as far as exports is concerned. We witnessed some slowness in the Europe and US market last year. We're seeing some recovery. That could be another lever for us to take our export share from 20% to 25%. These two are important deliverables. In addition to other markets, we are trying to increase our market share in the passenger car and in some geographies in two-wheelers too.
Right. So what I want to also know is just in terms of the last few commentaries that I was reading about from the company, you said about market share gain, right? Currently, I believe it's somewhere around 16% the market share. You want to move up. But what is the target that you have internally in terms of the next 2 years? Where should we expect this market share to move?
No, we don't have an overall target with respect to market share. We have specific targets with respect to categories. So currently, our market share is lower in case of commercial categories, particularly in truck and bus radial tires, and higher in two-wheelers. So our endeavor is to increase our market share in truck and bus radial tires and from about 8-9% to around 12%. In case of passenger car radial tires, we are around 15-16%. We would like it to go up by another 2%. And in two-wheelers too. So these are the three categories where we would like our market share to go up in the next 2 years. So that will translate to overall increase in market share.
I also want to talk about the raw material costs as well for you, right? Because that's clearly led to some pressure on your margins. What is your outlook on the kind of trend that one is likely to see for the RM basket and the cost movement thereof?
And there has been significant upward movement in natural rubber prices in the last 3 to 6 months. And Indian rubber prices today are at 12-year high. So therefore, in commodities, these spurts do happen. While international prices are not at that kind of a level, Indian prices are at premium to international prices. For example, the local prices currently are at around 207 to 209 rupees per kg, where international is about 10 to 12 rupees lower. One of the reasons for steep increase in the natural rubber prices is because of the freight component in the imports. We used to incur about $50 per ton as the freight for moving natural rubber from Southeast Asia to any of the two Indian ports, Chennai and JNPT. Now that $50 is hovering around $190 to $200. So that's one of the reasons for increase. And second, the lead times have gone up, particularly in imports. So what used to take about 3 weeks is now taking about 2 months. So domestic availability being limited, okay, and India produces little less than 60% of demand. So whenever there is a short-term blip in demand or short-term disruption in supply, that leads to some increase in prices. So we expect natural rubber prices to stabilize once the international issues relating to availability of containers and vessels stabilize. So which could happen maybe end of the current quarter. That's what our expectation is. And we don't expect raw material prices to move up. We expected some correction, some drop, maybe towards later part of the current quarter or beginning of next quarter. That is our current expectation.
Okay, surely that's your expectation coming in there. Just, furthermore, I want to understand, just continuing with the margins, how much was hit mainly due to the EPR expenses, and also did the promotional expenses due to IPL, was there any chance of that also maybe seeing a bit of that impact on the margins as well, this time at least?
See, EPR we had provided in quarter 4. So if you really look at quarter on quarter, there has not been any incremental effect on account of EPR costs. And in fact, we were able to buy EPR related or meet the EPR related obligations a little lower than what we anticipated in the beginning. So there's no incremental impact quarter on quarter. Generally, during IPL time, our marketing spend goes up. During the quarter that went by, not only IPL, but we were also active during the World Cup. So which will normalize from current quarter onwards. In the next 3 quarters, it should have a favorable impact on our margins.
Okay, Mr. Subbiah, thank you so much for joining in with us this morning on ET Now. It's a pleasure having you on the show.
If you like this video, then like, share and subscribe to ET Now.